Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire, McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial, investment, and retirement future, helping to uncomplicate the financial world. He is Chris McIntire, president and founder of McIntire Retirement Services. Chris, we always appreciate your time, guidance, and perspective here on the program.
Yeah, thank you. Good morning, everybody. Good to be with you, Peter.
Always a pleasure, Chris. And we do appreciate the time because it is a complicated, complex financial world. I think a lot of people have concerns with what they're seeing in the financial world and when they open their statements right now. And Chris, our planning outlook isn't necessarily helped by some of the topics that we are going to talk about today, which are common myths or misconceptions or assumptions that many of our plans and therefore our financial futures are based on that may or may not hold true, may or may not be reliable. We're going to examine several of these today. In fact, you've brought along a great report, the 7 financial myths. And we're going to be moving through these 7 big financial myths and talking about their validity, how much we can rely on them. But ladies and gentlemen, if you've got questions or concerns about your own plan, about the assumptions that your plan is based on for a rate of return, for tax rates into the future, for a rate of withdrawal, or for inflation, what those things mean to your plan determines your outcome. So let's carefully examine those as well as the rest of the myths that we're going to be talking about today. And you can get this report or you can review your own plan by giving Chris McIntire at McIntire Retirement Services a call. 800-868-1194. That's 800-868-1194. Chris, do you find that a lot of people are aware of the assumptions that their plan is based on and have questioned those thoroughly enough?
Well, it's a good question that you bring up, Peter. And there are people that have a fair amount of sophistication about them and, can handle the analytics of what the financial world does. And then there are other folks at the other extreme that, don't really, I don't want to use the word clueless, but, just don't follow it, don't like numbers. They're very intimidated by this whole grand scheme of things and, can't believe that they had that much money in their 401k, don't know how it happened. So, I hate to paint with a broad brush, but obviously we have a pretty broad-based audience out here after all these years of doing this show. And, I think that's why they hire us to help them, cut through, the minutia, so to speak, and some of the details, the financial lingo, if you will.
And when you are conducting that review and that strategy session, are you helping them to identify some of the things that their financial future may be based on that may not be as advertised or maybe misconceptions or myths about the financial world?
Oh, certainly, Peter. And, and with today's news cycle of 24/7 instantaneous this, that, market sell-off or market recovery, headlines, things flashing in red, you got to cut through some of those emotional buttons, and, let's be honest, these media companies know how to hit emotional buttons for people to get them to make some sort of, financial decision, whether it's to buy a new car that's, the latest and greatest, or if it's to invest in a new mutual fund or an exchange traded fund or, anything that Wall Street comes up with. And, many of the people that are listening to our show today, are only using Wall Street type vehicles for their retirement, stocks, bonds, and mutual funds, if you will.
Well, it really is what we have been taught and trained and encouraged to do. Aside from the money we may keep in the bank, we spend other dollars, but with the rest of it, we've been taught to put it in our 401ks, in our IRAs, in our 403bs. And really those options, Chris, by and large, are essentially all market-based and many highly risky and equity based. It works well when the market's going up. And that's myth number one on our list of the 7 financial myths. These are common planning mistakes and misconceptions to reconsider. Chris, the belief that we've been told that the market always goes up, or at least that we've heard that it always goes up over time. And I think there is a difference there.
Oh, there certainly is, and we're talking about the stock market here. Obviously, there is the bond market, the real estate market, the commodities market. But in general, the stock market is what we're all familiar with. We watch it on TV all day long here. If you're at the gym on a treadmill, you're watching the little ticker tapes go on there. And, if you're playing golf, it's good conversation with your buddies. And, some of the elements that you have to be aware of is, the market goes up, but look at what it's done this year. It's been a painful year here for stock investors. It's been a painful year for bond investors so far. Commodities have been, kind of the driver, right? Oil prices, wheat prices, natural gas prices, those types of commodities, lumber certainly going up. The real estate market has been very strong here lately. And, depending what they do with the interest rate environments, we'll see some of these market pieces ebb and flow as time goes on. But, do not bet your financial future on the stock market being this wonderful vehicle is guaranteed to give you success. It certainly is not guaranteed to give you success.
Now, here's kind of the bright side of that story is that over the course of history, the market, when it did have a downturn, has always not only come back, but always surpassed previous highs. But sometimes, Chris, that takes a good amount of time. There have been 16 bear markets over the last 100 years, and the average time it takes to get from top to bottom, let alone recovery, but just on the way down, is about a year and a half.
Yeah, it's amazing. And, I think we're seeing a pretty good shock to the system here in 2022 with inflation at 40 years high and, gasoline depending if you're buying gas or diesel and what week it is, it's, $5 to $7 a gallon, depending on what part of the country you're in. And none of us are used to that. I guarantee you that. And, that's a shock to the system. And then you walk into the grocery store. Well, guess what? All that food that you just bought was on a truck, probably using diesel fuel at $7 a gallon. And that's why it's costing so much. So sometimes they'll talk about that trickle down economics doesn't work, where money flows from the wealthy down to the poor, the trickle down economics. Well, trickle up inflation or trickle down inflation kills us all, basically, our purchasing power. And, we could run into a period of what they call stagflation, where we really don't grow anywhere. Everybody's just hanging on to what they've got, waiting for things to get better. So that's what they call stagflation, if you will.
Well, here's why this myth is important to consider carefully, is because, Chris, you have seen and talked about on the program, a lot of people's retirement projections, what they're basing their financial future on, seems to assume a linear, constant upward movement of the market. So just 1 or 2 down periods in the market could put them very much off the expected trajectory that they had set forth in those plans, or let's call them projections, when they're based on these kind of assumptions.
Sure, Peter. If you think of it this way, when the market's going down and you're still working, like some of the people listening to the show, hey, great buying opportunity because you're putting money into the stock market. Well, the exact opposite happens when you're retired and money starts going the other direction, which is something many of the people listening to the show today have not done in their entire working career, right? Pulled money out when things were going badly, but they still need to pay their bills and they're retired and pulling money out of 401ks and IRAs. So, when the market falls 10, 15, 20%, for example, now they got 20% less money and they're still pulling the same amount of money they were doing when they had $1 million that they're doing when they have 800,000, to use that 20% correction analogy.
And we're told that the market always goes up or always goes up over time. But then we also hear the phrase, don't worry, it always comes back. However, for those in retirement, Chris, for those in that description that you just gave that are pulling money out to live on in retirement, they don't have the luxury of being able to wait for things to come back. We need a consistent income, which again is why we need to carefully examine this myth or misconception that the market will always go up in a linear fashion. And number two myth sort of segues into that, not only that the market always goes up in some straight linear fashion, Chris, but that we can assume an average rate of return to be dependable.
Yeah, you're exactly right. And, hey, the market's averaged 10% a year since its inception, all right.
We've all heard that one. Yeah.
Right. We've all heard that one. That means your money's going to double in 7 years, every 7 years. And, when we're in retirement, pulling money out, those large drawdowns, certainly have an impact on the ability to sustain those portfolio pieces. And, Peter, I'm going to throw back to you on, tell us what a 10% average is.
Yeah, well, undependable. I think that's the main part of this is that not only can we not rely on a 10% average rate of return, but even if they are showing past performance, Chris, averaging 10%, that may not be the actual result on our money. And so we've talked about the scenario before, and I know math is a little difficult and numbers difficult over the radio, but we'll put a graphic up on screen to show this as well if you're watching on the video. If you start with $100,000 and you get a 60% return, and then a negative 50% return, and then a 20% return. So positive 60 minus 50 is 10 plus 20, that's 30 divided by 3. That's an average 10% rate of return over that period of time. But what happens with your money with a 60% rate of return, Chris, 100,000 turns to 160,000. With a 50% loss, it turns to 80,000. And then with a 20% gain, it turns to 96. So we've had a 3-year period where if this was a mutual fund, they could advertise a past 3-year performance of an average 10% rate of return. But our money, we've actually gone from 100,000 to 96,000. And that's before any kind of internal fees or cost or expense ratios or advisory fees or withdrawals, Chris.
Yeah, and that's a shocking statistic when you look at it that way. And, I suppose we could say, well, what's the odds the market's going to go up 60 and then fall 50%? Yeah, we can, skew the math here on the radio show to kind of drive our point home, but in 2008, when the market fell 35%, it had to recover 43 to 45% just for folks to get back to the break even piece, and 2008 was a financial crisis that the federal government came in and helped bail out the banks and added stimulus to the system. 2020, the COVID pandemic hit, and the federal government added trillions of dollars of stimulus, overstimulated the economy. I think we could make that argument because look at the inflation impact to that now. If we turn the clock back to a 2000, a 2001, and 2002, there we had a prolonged recession, not a financial crisis, but a recession that lasted 920 days, I believe it was. So just about, close to that 2.5 to a 3-year time frame. And, can you imagine if you would have retired, Peter, in say 1999 and you had this big nest egg, and then the next 2.5 years of your retirement lifestyle, you lost 50% of your money in the stock market? A lot of those folks then, capitulate, get out at the bottom, and don't get back in on the way up until they've missed a significant piece of the recovery. So, that is why it is so important to, have more than one strategy in place. We've advocated on this radio show for 10 years, essentially, of look, here's why you have a safe money strategy so that when bad things happen, you can stop pulling money out of your investments that may be down in value for hopefully a short period of time, but nobody really knows until you come out on the other side of it. And you can pull money out of something that maybe didn't lose any money, might not have made anything, but it's certainly better than pulling money out of an account that has lost a significant portion of its asset base.
Chris, a lot of those folks that retired in 1999 or 2000, because of that downturn, because of that lost decade, because of really about 13 years where the total return of the market was essentially zero, they had to make significant adjustments to lifestyle. And some of them really never have recovered. Some went back to careers and working again in order to help to recover. And a lot of people listening right now probably are saying, well, I still made good money over that period of time. Here's the thing, Chris, if you were making contributions, then you did benefit from those downturns and that decade where the market was essentially flat, but took a 50% loss and 100% gain, and then another almost 50% loss, and then back up over 13 years, a net flat break even. But if you were making contributions, you benefited. However, if you had a finite fixed amount of life savings and money before that period, you did not benefit from those downturns. And in fact, dollar cost ravaging sequence of returns risk, taking withdrawals in those down periods, has quite the opposite effect. That really locked in losses and put their projections or assumptions for what that period of time right after retirement would look like really off track. And Chris, we just don't know when periods like that will occur.
Sure. You get a year like 2022, Peter, and, it's a great buying opportunity for those that have time to continue to invest. For those that are just retiring and watching their nest egg shrink, and we have clients that have, are experiencing this, just like everybody else is, just like I am, just like you are, Peter. And, an understanding that, if I'm in the accumulation phase of money, it's one thing, it's a buying opportunity. If I'm in the distribution phase of money where I'm paying it out to myself, boy, it's an emotional gut check, if you will, for a lot of folks out there. And again, that's why you have other alternative strategies in place. Most of you have saved plenty of money to get through retirement that listen to our radio show here, and you have the room to have a plan A and then maybe a plan B, if you will, and not to say that A is more important than B, but a couple of different alternatives that are trying to achieve a couple of different goals. Plan B might be your sleep insurance, if you will, or, your comfort factor of having some money to get you through some of the tough times in the market that, hey, could last 1, 2, 3 years. Who knows? That's the crazy thing on the investment front is we have not had a prolonged period of, kind of that stagflation where we go nowhere, which typically coincides with a high inflationary environment. If you were going to go back and look at the S&P 500 chart or the Dow Jones Industrial Average chart, and we're going to look at that and concentrate, in that period of the mid 60s to call it 1980 or 1979, if you will, where we had very high inflation and very little in the way of market returns.
Well, again, we are talking with Chris McIntire, president and founder of McIntire Retirement Services. We are reviewing a report that he has put together that would be helpful for you to consider each aspect of this. The 7 financial myths, common planning mistakes or misconceptions that you need to carefully examine your plan and projections to see if your financial future is reliant upon. And if you'd like this list to go over on your own time, or if you'd like to review your individual specific circumstances and your plan to see what assumptions your financial future is based on, and then discuss with a qualified, experienced professional whether or not those are reliable or need to be questioned, pick up the phone and give Chris McIntire and McIntire Retirement Services a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, number 2 on this list is the assumption that we can count on some 10% market rate of return over time. There are tools and calculators where you can go and you can calculate what the compound annual rate of return of different market indices has been. If you look at the S&P from the beginning of the 2000s, January 1st of 2000, all the way through the end of the year 2021, the compound annual rate of return has only been about 5.7%. And if you take this recent downturn in 2022, it falls down to about 4.7%. But when you inflation adjust that, the CPI, cost of living increase that happens over time, that rate of return, annualized S&P 500 rate of return, falls to just 2.43%. Now, if you're assuming a 10% average rate of return to carry you through retirement, and then we go through a period where it's 5.5 or 4 or 2, that's going to put you far, far off of your assumed, your projected standard of living and financial status into the future. And that's why we got to carefully examine these myths. As well as number 3 on the list, Chris, the amount of cash flow that we can generate from a portfolio is often overestimated. We really need to be careful assuming how much we can take from our portfolio in income withdrawals.
Certainly, Peter. And, you're sharing some information for those that watch us on a podcast here, and that previously just had a chart there showing the S&P 500 and those annualized returns. And if you look at the dividends that the companies in the S&P 500 pay, it's about 2% historically. So if you hear of a 4% rule of thumb as a withdrawal rate, right? Well, you need to have growth and dividends coming out of that if you're going to buy an index fund of the S&P 500, for example. So if you don't get the growth, the dividends don't support that 4% rule, if you will, and then you have to adjust that for inflation. We've come through this historic low interest rate environment, Peter, where, it's been hard to generate income out of a bond portfolio, for example, when the yield on a 10-year government bond has been below 1 to 2% for, 5 years, for example. And now we're starting to see that tick up here a little bit as they're raising some interest rates. But man, it has really been a challenge creating that steady flow of income with traditional investments of stocks and bonds. You might have to look outside and really cherry pick the best dividend paying stocks. You might have to look more at real estate. You might have to add an annuity to your portfolio mix to give you that lifetime income piece as well, with some potential to keep pace with inflation on increasing income. And, so adding a number of different tools that are available are certainly going to help the average retiree. And, unfortunately, in my business, my industry is, there are certain wealth management companies that are against someone buying an annuity and hedging. The biggest risk that we all face is longevity. Now, you got to ask yourself, what kind of company would say, look, there's one tool that can guarantee that people don't run out of money, and it is an annuity. Okay. Why would you not want to incorporate that to hedge the number one fear or risk that all people have as they go into retirement, is running out of money? I'm going to step off my soapbox there, but that stuff drives me crazy. That's that misinformation with all this mass media that we have sometimes, Peter.
But the Wall Street model, Chris, which for about 30 years has assumed a 4% cash flow as the acceptable income rate, if you run the calculators on that, it still leaves about a 10% probability, likelihood, 10% chance of running out of money over a 30-year retirement. And the man who incepted that rule, a financial analyst by the name of William Bengen, we've interviewed him here on the program before, Chris, and even he said that rule was always meant for institutional investment rather than individual investors, because for the individual investor, they don't have the law of large numbers. It's dependent on them. That 10% chance can completely lead them off track. He also said that 4% rule negated the potential of a large market drawdown in the first few years of retirement, which is a big factor to kind of negate and put off the table. So again, if your Wall Street based financial plan, retirement plan, is based on one of these widely accepted rules, but really is an assumption, then you need to carefully examine that for your financial future and your financial stability's sake. And Chris McIntire can help you identify where within your plan you have assumptions, and then talk those through with you. Do you want to be rose-colored glasses and pie in the sky? Or do you want to be more conservative or even pessimistic with your assumptions so that you know if things don't go the way you've assumed, you're in better or worse shape? That's the kind of questioning and that's the kind of discussions that you can have with Chris McIntire. And these are just 7 of the big ones, ladies and gentlemen, that are on this report, 7 financial myths and misconceptions. So if you'd like this list, or if you'd like to have those conversations with a qualified, experienced financial and retirement planning professional, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194. Chris, this next one is a big one. I know it's one of your favorites. The belief, the assumption that taxes will be lower in retirement. Now, we haven't found this anywhere in the tax code yet.
No, we have not. No one has written that in stone. Moses isn't standing up on the hill there holding that out to us as one of the 10 commandments by any stretch. And yeah, it's true that some of the people that are retired right now are retired in a very low, historically low income tax environment, even capital gains taxes for those non-IRA investment pieces. There is no guarantee that's going to continue to be the case. I think we just cracked $30 trillion in deficits that the U.S. has. And at some point we'll have to begin to pay that back sometime. And to be politically neutral, neither the Republicans nor the Democrats have done a whole heck of a lot to make that debt go away. And, it was just back in the mid 90s where we had a budget surplus. So, the way that governments raise money or control spending, I should say, is raising taxes or lowering spending. And lowering spending, once someone gets that, government handout, certainly is hard to take away. They've talked about modifying Social Security or privatizing it. And the other political party says, well, you're trying to take grandma's money. Or if they want to make some changes to certain educational programs, well, you're trying to, push the kids out on the street. So, I mean, it's a political football that, that gets passed back and forth. And unfortunately, taxes, if you were to ask the people listening to the show today, do they think they're going to go up or down during their retirement? I would say overwhelmingly they would think taxes will go up. So we have to pay attention to how they manage those withdrawals on IRAs, 401k accounts, all those pre-tax dollars that you haven't paid any tax on. Now you're in retirement. Now, when you pull it out, you will have to pay the tax. The more you pull out, the more tax you'll pay. So, understanding your tax equation is certainly very important to your long-term retirement success.
And Chris, again, a factor that you carefully examine, you help crunch the numbers. You're a self-proclaimed tax geek. You really dig in on this side of it because it's not what we have, it's what we get to keep. And there are strategies available to help your clients and proactive savers and investors to control and minimize the ultimate lifetime tax liability. But we do need to be, key word there, proactive, really historically low tax environment right now. But that's right now. We don't know what the future holds. So it's good to be active and proactive on this front right now.
Correct, Peter. And, something to certainly have a plan together, have a good working relationship with a CPA, or if you're, doing your own taxes on TurboTax, run some what if scenarios, looking at Roth conversions, if you will, and when those may or may not make sense for your own individual case. And Peter, I'm going to transition here, if you don't mind. I'm going to go to the next talking point here for us. I know we're running against the clock here.
For the sake of time, let's do it.
Yep. So we have a lot of folks that say, look, I'm in retirement. I got everything paid off. I don't need life insurance now. Okay. Well, I'm going to tie this into, life insurance, long-term care coverage, because sometimes those two go hand in hand together. Maybe you've got everything paid off, but you go into an assisted living facility, potential nursing home, dementia wards, Alzheimer's units, things like that can be hundreds of thousands of dollars in your retirement. Whose money do you want to use to pay that? Your own, or do you want to leverage leverage an insurance company's assets for, that potential risk? And, personally, we help somebody who has Alzheimer's right now, and, it's about $100,000 a year, and they plan for it 20 some years ago, and it covers 100% of her bill right now.
Yeah, something that nobody loves to think about, but something that we have to plan proactively for. That's a huge potential elephant in the room in planning, if you will. And having that life insurance can, especially as a married couple, give you the confidence to spend and enjoy retirement together during your mutual lifetimes and provide the protection to either cover those healthcare expenses or refill the bucket of assets if and when something happens. And I think that it is a valuable conversation. Don't just make the assumption that just because you have the debts paid off, the kids are up and out of the house, you're not replacing a paycheck, and you've got the largest amount of money, hopefully, that you've been able to accumulate in the course of your whole lifetime as you enter into retirement, that lump sum won't have the tendency to be spent from during retirement. And then you want to give each other something to replenish that bucket or cover those potential healthcare costs. So still a need for some insurance there, or at least the need for a discussion about the benefits and the costs of all of these factors: taxes, market losses, insurance. All of these are many assumptions that people are making in their plan, whether they're aware of it or not. We need to carefully examine that in the planning process and be proactive as possible in addressing these items. We won't have time to get to every item on the list, but those are 5 good ones to get started with, ladies and gentlemen. And if you'd like the rest of the list of the 7 common financial myths, pick up the phone, give Chris McIntire a call if you'd like to go through a proactive planning review and strategy session to identify and then discuss the assumptions that your financial future is based on. Pick up the phone and give McIntire Retirement Services a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, always a pleasure. You always bring up a great perspective, points to consider, information that savers and investors need to know.
My pleasure, Peter. It was a lot we covered here today. I hope you folks enjoyed the show. Stay safe, everybody. Thank you for listening.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement.
The content of this radio show is provided for informational
subscribe.
purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.